If you still believe in the Bitcoin halving, if you still believe in the 4-year cycle that Bitcoin goes through those predictive bull markets and bear markets, then I've got a few things to talk about with you. At the beginning, it all makes sense, right? At the face of it, it seems to be relatively obvious when the newly issued supply gets lower, when there's less of something, then the price should go up. Right? And every 4 years, there's less and less Bitcoin that hits the market. And so logically from this would conclude that the market cap of Bitcoin should go up as there's less and less new supply hitting the market. So this also seems to make some kind of sense. And some people even made mathematical models around this, right? There is the stock to flow model that says that every 4 years, the market cap of Bitcoin should roughly 10x because the supply gets cut in half. The reason why it 10x's and why it doesn't double is because of a regression analysis. So the guy that made the stock to flow model, he looked at other markets. He looked at the silver market, at the gold market, at all kinds of precious metals markets. And he found out that the more new stuff gets issued, of course, the less the market cap should be. And if you just make a regression analysis of newly issued things versus the market cap, you come up with roughly that ratio. So it all kind of makes sense until it doesn't, until we actually test that thesis. To a degree, it does make sense, but it doesn't make sense anymore. So we are currently at 0.85% of all of Bitcoin supply getting issued every year. So a few months back, that was 1.6% or 1.7%, right? So it got cut in half. We've seen the Bitcoin halving. And historically, what happened is that 7 months after the halving, we'd see a massive rally because, again, the supply contracted, right? And so the price should go up. But there's a problem here. Let's test this thesis within the crypto space. So let's look, for example, at meme coins. A lot of meme coins start off with the entire supply. They have zero inflation, and they don't necessarily go up into infinity with their price. Well, let's do something more tangible. Let's go with Ethereum. Ethereum has had a change to its tokenomics. So now the newly issued supply can potentially contract as more and more Ethereum is being used and as ETH tokens get burned. Since the change from Ethereum from proof of work to proof of stake, the tokenomics around issuance have changed massively. And there was actually a reduction in Ethereum's supply by 0.3%. So the overall supply of Ethereum that's circulating shrunk. What that should mean, right, when we look at this relative to Bitcoin is that now Ethereum should outperform Bitcoin because there's less and less Ethereum, there's more and more Bitcoin. And so relatively speaking, Ethereum should be outperforming Bitcoin. In fact, though, what we see is that Ethereum, since the merge, underperformed Bitcoin quite massively. Ethereum underperformed pretty much the entire crypto space since the merge. How is that possible when the supply is shrinking? I think the answer in all of this is simply what magnitude of supply change we are seeing. So obviously supply changes do matter, right? Because the price is the result of the delta that we see in the supply versus the delta that we see in the demand. And so if supply grows faster than demand, price should go down and vice versa. So obviously, since supply is one side of the equation, when the supply goes down, there is a possibility for the price to rise when the demand stays stable. But the issue is that the impact that now the halving has, or that the Ethereum tokenomics impact has, it's not that big anymore. We are looking maybe at 1 percentage point, maybe 2 percentage points, now even 0.8 percentage point per year in difference. That's not that much. When you have a halving event in the early days, right, and the newly issued Bitcoin supply goes from 40% per annum to 20, and then from 20% to 10, and then from 10 to 5, this there can have an impact. But when you go from 1.6% per annum to 0.8%, the impact is very, very marginal. I believe nowadays we can pretty much forget about all of the Bitcoin mining, all of the Ethereum issuance, etc. because it's simply such a small factor in the grand scheme of things. What really matters now is the supply that comes from the long-term holders, because that fluctuates much more than the mining. So we have to look at what are the OGs doing? What are the very first investors in Ethereum doing? Are they selling because they hold a lot of the supply? What happens with the very long-term holders of Bitcoin? When are they selling? When are they buying back in? Those kinds of movements are 10%, 20%, 30% of all of supply. It's not just less than 1%. That's really what matters.
Here are the videos that work on YouTube. XRP will be $12,000 guaranteed, or an AI explosion, top 3 cryptos to buy in November. A lot of pushing of greed, that's what gets the clicks. What doesn't get the click is a tutorial on how to make backtests, on how to build those sheets that in the end figure out what historically worked well in the past. The backtest that I often show here on this channel. I still very much enjoy producing this kind of content though. I also share these kinds of sheets, but I don't do it on YouTube. You also get direct access to me. Feel free to check it out. It's thebitcoinstrategy.com.
And so since the newly issued supply for the major cryptocurrencies is pretty much zero, it's not really that impactful. We simply just have to look at on-chain analytics. So this is why I like crypto so much. In crypto, we've got way more data than in traditional finance. We can actually look at what is the smart money doing. The people that used to make money in the past, the people that have a lot of Bitcoin, the people that have a lot of Ethereum, those kinds of people, right? What are they doing? We can actually find this out on-chain. We can look at Bitcoin long-term holders, right? Simply Google this, right? Bitcoin long-term holder chart. And check those different charts that you get from different websites and see how nicely they correlate with the Bitcoin cycles. The long-term holders tend to take profit as Bitcoin makes new all-time highs, and they tend to buy in when Bitcoin starts to get depressed. And this is the kind of way I think timing the market makes most sense, right? It makes sense to follow the smart money. It does not necessarily make sense to just follow a random narrative around a Bitcoin halving. It can be very much possible that the long-term holders sell already earlier than they used to, right? They might already sell when Bitcoin just goes to 80K and to 90K, and they might have already made enough money because they bought in very low, and vice versa, right? They might be buying in maybe much later. Maybe they wait for a 50, 60, 70% drop before start buying. And those kinds of signals, I think, are better than just 100% rely on a structure that used to be relevant in the past because the supply dynamics really did shift quite a lot in the past, but that might not be that applicable today anymore because, again, it's only 0.8% that changes in the overall supply with a halving. So nowadays, supply is all about liquid supply. It's all about the supply that's locked up by those long-term holders. When does this become liquid? Demand, luckily enough, can also be measured quite nicely on-chain. We can look at adoption metrics. Now, adoption metrics can be different for different cryptocurrencies, right? For example, in Bitcoin, I think the best adoption metric is simply just the number of wallets that hold, for example, 0.1 Bitcoin. Let's just have a look at the number of wallets that hold 0.1 Bitcoin. That tends to go up over time. So the people that save in Bitcoin tends to grow. The investor base tends to grow. So this is positive. So this is why I think over the long term, Bitcoin is likely going to rise in price because the fiat base expands over time, right? The US is going to continue to print money, but also because Bitcoin as a savings vehicle continues to see adoption. With Ethereum, I'm not sure if you can actually say that. I'm not sure if Ethereum is that great of a savings vehicle because the monetary policy, right, around issuance, etc., can simply just get changed at any point in time. And so maybe the better measure for Ethereum is how much is it used, right? How many transactions happen on Ethereum? How many smart contracts get deployed? How much actual usage of Ethereum plus its layer 2s, right? Plus Arbitrum, Optimism, etc., Polygon, all of layer 2s. How much is this actually used? If this increases over time, that's good. If it doesn't increase over time, that's bad. But for Ethereum, we can't just look at the number of wallets because, again, very few people save in Ethereum. So the game is still about demand and supply, of course, right? This is always how any market works. The intersection between the two is what determines the price. But what really determines the supply is now different because the tokenomics in the 0. whatever percentage range doesn't really impact the overall dynamics that much. It's much more what the long-term holders are doing. And same for demand, right? In the early days, it might have been a lot of short-term speculation that pushed the prices up and down. Nowadays, as the market caps are higher and as the average investor tends to hold for longer term, it's more about adoption. So it's not that much anymore about what are short-term holders buying and selling. It's more about, in my opinion, how much continued adoption do we see, how many wallets over time continue to accumulate Bitcoin, for example. I believe the Bitcoin halving is a distraction. I believe that the crypto market, especially the larger caps, have already matured to a degree that it's now other factors that really impact the price. The volatility over time is going down. The returns over time are going down as well. We won't make 100x returns in the larger caps anymore, and that's all fine. What all of those ups and downs, all of those bull and bear markets have brought us is a completely new asset class, right? An asset class that is very lowly correlated to everything else. We can buy Bitcoin and pretty much be unfazed by what technology stocks are doing. The correlation between Bitcoin and the Nasdaq 100 is still very, very low. We can buy Bitcoin and not worry too much about the property market, not worry too much about the bond market. The correlation with the traditional finance world and crypto is relatively low, and that is what makes it so attractive, because finally we can reduce our overall portfolio volatility even more, while actually even boosting our expected return. Early adopters of Bitcoin said it already in the early days, and I believe it applies even more today. It's not that important anymore to time the market. It's much more important to simply get enough sufficient exposure. If you've got already 2, 3, 4 years of your income saved in wealth, and you don't have at least 5% of that wealth in Bitcoin, I believe that's a mistake. I believe it's even justified to have 10 or even 20% of your overall wealth in Bitcoin, even when you're somewhat conservative, because I do believe it's now a very established asset class. We simply see the long-term adoption metrics continue to grow, and we see how fiat tends to get printed very quickly, and the Bitcoin supply doesn't expand to that degree. The Bitcoin supply, in fact, actually also shrinks, because the rate of mining is slower than the rate at which Bitcoin gets lost. So actually, just in terms of liquid supply, we do see how Bitcoin does become rarer over time. Feel free to give this video a like to help the channel grow. Feel free to also subscribe in case it's your very first time here. There's also a Telegram channel. The link is down below. Looking very much forward to seeing you on Telegram as well. See you over there. Looking forward to chatting with you. Cheers.